Good morning, everyone. It's JJ at Micro E Futures. I hope you're having a great weekend. Doing a little video here on how I find these balance zones, why I think balance is important with respect to running a business, and how you can use these to get some targets on a whatever time frame you're using. Here I'm using a 1 minute chart, and the other thing is how to help you manage your risk and trade in the right direction. It really, really, if you think about it, there's so much information that's on a chart that is being neglected. And I think it would be a wonderful addition to technical analysis because it would help technicians understand the mechanics of what is causing the pattern that they're seeing over and over again because the business repeats itself, right? It's a market, so we build an inventory, right? We have a cost basis of that inventory, right? That's the goods that you're planning to sell. Now, prices may dip underneath that cost basis, and we'll show you that, but generally the optimum business result is to take that cost base, right? That inventory, right? That has a price around it and go sell it for a profit, right? Pretty simple. So here we have a cost basis, right? What I'm finding and I'm looking for in a cost basis is I look for a high and a low. And when we look below that low, we come back to that high. And that's the foundation of pretty much my go-to trade. And that trade can be scaled in time and in size. Now, I don't hold overnight and I don't trade big size. But for those who do, it's the same business principle as, when the sell orders are complete, supply runs out. So for a moment, whatever moment in time that is, time frame, if it's for a minute, if it's for an hour, it's a day, the market will run out of people willing to sell at a certain price. Those sellers are completed, the market moves higher to find buyers. So that is the cost basis and the explanation for it. Now, if I'm going to draw a volume profile from this high to the low, and you'll see that the bulk of that volume is in the cost basis, right? That's what we're looking at. We're looking to see this part right here, right? You volume profile traders call this a high volume node. Okay. It's a fancy way of saying that's where all the goodies are, right? That's the majority of the price. Most of the inventory is priced at this level here. That's what it's just saying, right? So this is your inventory, and the majority of that inventory is priced here. So moves up from that to distribute for a profit. Sometimes you got to put it on sale underneath cost basis. So how do we now use this information to trade? Let me just get rid of the volume profile. Now we take this cost basis and we double it, okay? Because your inventory is priced at a certain level, selling it for double that level is good profit. Now, what happens if sales are bad? What happens if you have a whole bunch of competition coming in your market selling the same product that you have, but they've got a lower cost basis? Well, then you're going to have to do some fancy footwork. And if we're retail traders, we have to get out if, that level doesn't hold. But you double it to the upside and downside to get viable targets. You can use the middle to close off trades. I don't like to use the middle of the zones to initiate unless I'm really on the ball. And it's easy to say, oh, great, you can take that trade. But in the heat of the moment, if you're really not on the ball and good with your risk, you can mess that up. And you know, if I'm in a if I'm in a more mess it up than do well stage, then I'll only take trades at the edges of the zones. So when we do that, look below and you fail and you come up, you buy a little here, you put your stop under here, and your target's the top of the zone, right? And it's a great way to learn how to manage risk, because if you're long when it looks below and then fails, you put your stop down here, underneath these candles. And while you're in the trade, if the market breaks 76, then oh, it's breaking 76. I'm probably going to get stopped out. You can mentally prepare yourself for being stopped out because the order flow at the time didn't match what your business intentions were. And that happens, right? So we use that information. Maybe we can take the trade later. Maybe we wait. Here's another example of a trade where it fails to look below. That's a hard one because you got to get in there quick, but this is a 3 point balance. You can, if you're using a larger time frame, maybe a 5 or a 15 minute or whatever you're using, you can maybe use a larger rotation of inventory, like maybe 6 points or 8 points, whatever you prefer. I like to keep it on a 1 minute because it forces me to think quick. Um, and it forces me to focus. But that's just me, and it's a great way to learn too, because when you're on a 1 minute, your risk is really, really tight. So you're not going to be blowing up accounts and doing FOMO trades if you know where your trades are, where the exit of your trade is. And if you know the reason why you're putting on the trade, if you understand the concept that is driving that trade, when the driving force behind that trade, when it stops working, after a while, you'll see it and you'll know how to get out of it without losing too much money. And because we always make mistakes, we're not infallible. We're going to make mistakes, but we just need to admit we're wrong quickly, instead of being, stubborn. So anyway, this helps with everything. This is how you find a balance zone. That's how you double it. Oh, for people who like to short sell, when the market looks above and fails, you can initiate your short here. You can put your stop at the top of those candles and put your bids down here. So when the market comes in, you get hit and you cover, right? If the market can't break the middle of a zone, then you know that the sell orders have started to complete. Anyway, these are practical ways that you can use a candle chart. Now you can take your technicals and your VWAP and all of that stuff and throw it on top. But now you understand the basic mechanics of how inventory is priced, how it's marked up and sold, and then put on sale back to cost basis when nobody wants to buy it. Okay. So please drop by our Micro E Futures room, ask lots of questions. We got a 7-day free trial, right? Come in. It's a little bit different. I teach you why the trade works. And we really focus a lot on risk management because we hate to see people lose money. That's not cool. So anyway, drop by. I hope you're having a wonderful weekend. It's JJ from microefutures.com. We'll see you later on tonight at the Globex Open. Have a wonderful Sunday. Thank you, everyone.